So diversification is the only free lunch that exists in finance, and I'll explain why that is the case. So this is the classic efficient frontier chart. You've probably seen it in any proposal from Morgan Stanley to free classes on YouTube. And the idea is quite simple. It goes back to that original chart, which tells you that, hey, the more risk you take on an asset, the greater the return that you're going to get. So if you plot Bitcoin on that chart, like you see crypto, there's a lot of risk, there's a lot of return. Equities are in the middle, bonds are the least. But the reality is if you have assets that are completely uncorrelated to each other, you can get the same rate of return, but you can dramatically reduce the risk. So the classic example is you have two assets that are perfectly uncorrelated to one another. One has the probability.
And just to clarify this, folks, when people say uncorrelated, there's a lot of assets that so for instance, if we were talking about interest rates, if interest rates go down, that generally means people make riskier investments. And so tech stocks will likely, as a basket, go up. So tech stocks are inversely correlated to the interest rate. As the interest rate goes down, tech stocks are likely to go up. Well, I guess that's true broadly of the market, right? As interest rates go down, the market often goes up.
Well, that's not necessarily true because it's the reasons why our interest rates going down. If you go through a financial crisis and there's emergency rate cuts,
fair enough. Fair enough. Yeah.
So it really depends. But the idea is these assets may be correlated, may not be correlated. So like in 2022, bonds were directly correlated with equities. They both fell together. In 2021, they were inversely correlated. So these things ebb and flow with time, which is why it's important to have multiple non-correlated things in your portfolio. So, if you own Coke and you own Apple, that doesn't mean you're diversified. But let's take, in a hypothetical scenario, you have two assets that are totally uncorrelated with one another, like gold or S&P. They don't show a consistent correlation over time. If both of them have the ability of moving up 20% in a year or losing 20% in a year, but they're completely uncorrelated, the probability of them both losing 20% in a given year is cut by half. So then you stack more assets like this on top of one another in a portfolio. Now you have 10 of them. What's the probability of all 10 going through a similar loss at the same time? It becomes a very small probability. And that's how you create stability in the portfolio over time, which is why the more assets that are not correlated, that are stacked on top of one another in a portfolio, that efficient frontier gets shifted more and more to the left, but that doesn't sacrifice the return per se. So you can play around with that, and you can, this is the science part or the alchemy part, and that's how you're creating the most amount of consistency in the investment portfolio. But the key to that is non-correlation.
Yeah. And this is why it's the only free lunch, is typically you're trading off return for risk, except if you diversify where you can get the same return with less risk, right?
That is exactly right. Or the same risk, right? Depends. So you can decide what your risk tolerance is, and you can structure it based on that decision.
Yeah, exactly. And that's probably the better way to frame it is typically when you're working with folks, you're figuring out what is their risk and their time horizon. And then it's through diversification, you can get a higher return for that same risk than if they made kind of a concentrated bet in a specific area.
That's exactly right.
Now let's understand. So there's, let's say diversification, it's the only free lunch. Diversification allows you to reduce risk or to get a higher return on the same risk. Now, why is it so important to minimize volatility and really cut down years versus just having a concentrated bet? So, another way is like, why don't we go 100% stock or 100% Apple versus getting this diversified portfolio?
Yeah, that's the key question. And it goes back to that power of consistency and that initial chart we showed, 7% over 30 years, and you have that huge compounding growth. That's because you're not losing any money in any given year, and that 7% is consistent. So volatility mitigation and consistency is key for that because of the way math works. Very simple. It's what we call the geometric loss curve. And what that means is that the more money you lose, the more money you need, the more percentage-wise you need in order to get back to where you were. So I'll give you a real-world example. Let's say you bought the market and it's October of 2007, and you're adhering to the advice that you should always buy the market regardless. You can't time it. It's great. You buy only stocks October 2007. In the next year and a half, the market's down 55%. Let's say it's 50% to make things simple. that means your $1 million is now $500,000. So I'm not even talking about the emotional pain that's associated with it. That is a very real thing. So there is a emotional reason why you want to mitigate volatility, because people have a strong emotional relationship with money, so they don't want to go through that. But let's say you're completely ignoring it and you're talking scientific term only. You now need to make 100% on your money in order to get back to where you were initially. And that just takes time, because even if you accept that over the last 30 years, the S&P has done something close to 10%, that's a lot of time in order to get back to where you were. So in that case, 2007, the market gets back to where it was in 2013. So when you're talking about that 30-year time horizon for the chart, you just killed a lot of years for that compounding you could have had. So that's why you want to mitigate volatility in a big way. In an extreme example, let's talk about the dot-com bust of 2000, 2003. The NASDAQ dropped 87%. So if you were all into QQQ at that time, you were basically, you didn't make a new high for quite some time. You needed extreme compounding for that.
Yeah, right. I think it really, this is the chart on the left is, I think, what's kind of important here, right? Is, a lot of these times when we talk about the market and they're talking about historical returns over a 20-year, 50-year time period, it's assuming it's linear. And, we've talked a lot, and, this is, I forgot what the numbers you mentioned is, the market's actually kind of sideways for most of its time. It's down for X% of the time, and it's up a certain percent of the time. If the market goes down 25%, you need to get 33% returns to get back to even. And so really I'm just going to go back here. To get this curve on the right, the market isn't smooth. This is obviously showing it's flat, but it's actually up and down. And if you have those really bad down years, particularly early on, you need sizable up years to be able to really catch up. And so there is like a big timing thing that can really impact your returns. And so that's where this is coming from. Another way to frame this is, how do you avoid down years without cutting your returns?
Exactly. And we go back to diversification for that answer. But to me, that's the ultimate kind of like trap that the wealth managers a lot of times show you when they show you these long-term linear charts. And you're like, well, the stock market does 10% a year. I mean, that's great. But then you're extrapolating these linear returns. The market just doesn't work that way. So it goes back to that holy grail chart here to the right, which shows you how many non-correlated assets you have in the portfolio. So you can see that as you get more and more uncorrelated assets in the portfolio volatility just completely goes down. And what you want to do is you want to maximize the return, and you want to minimize the volatility as much as humanly possible. And that's the goal of what we're trying to do.
Yeah. Now, so let's say, and so okay, so if you accept the premise of diversification is valuable, and really you can get a high return at the same risk level. Now, what does that mean of people? I think the traditional level of diversification is there's something called the 60-40 portfolio, which is 60% stocks or the public stock market, 40% bonds, which may be a mix of treasuries, corporate, municipal. That's kind of, that's traditional. How do you think about what are different asset classes, and how do you think about what is true diversification?
Yeah, so we've done a lot of work on that just to see what's in a portfolio of an institution, an endowment, a family office. You mentioned at the beginning, what are these big family offices do? Well, these big family offices tend to have about 50, as much as 70% into alternative assets. And these alternative assets may include real estate. They may include private equity. They may include venture allocation. They may include a lot of hedge funds. They may include commodity strategies, and other things that create this type of diversification element. And one of the main issues historically is that retail investors, or kind of smaller accredited investors, had a very difficult time accessing and building these type of portfolios, because they tend to be very complex, and they tend to require a lot of money in order to build. So, take a hedge fund, for example, like one of the top performing hedge funds, like Millennium, that has consistently done 10, 12% a year for decades. And their minimum is $25 million, right? So historically, there's been significant barriers in order to build that type of diversification and portfolio. And that's one of the problems Equity was founded in order to solve. I think you're muted, Moni.
You bring up kind of a very interesting thing. When people everyone on this webinar has probably heard of hedge funds. An interesting thing of, one of the things I always assumed, and this is, hedge funds, obviously people want total returns, but actually what the number one thing they're really solving for is being non-correlated to the market for really what you're talking about, right? And it's this essentially portfolio construction is what Millennium is known for. It's not known for getting, Renaissance returns. What they're known for is every single year you're going to get a consistent return because of portfolio construction effectively, right?
That's right. That's right. And they have hundreds of managers and strategies in there to create that type of consistency.
Yeah, and then what they're really known for is actually it's like their risk modeling to figure out how to allocate between those different portfolio managers to really create that zero correlated exposure so they can get that solid 10 11 12% a year. They're not trying to do a 30% year and then a negative 10% year. They're just trying to get 10 10 10 10 every single year so they can replicate that curve we saw earlier.
And if you have $100 million, that's the dream, right? Like you don't need to take that volatility. It's just a matter of time until you compound into the billions.
Yeah. Now there's a question here from Richard. His question is at what level of wealth should someone consider, this kind of broader diversification strategy of private equity, real estate, hedge funds, private credits? When does that start to make sense?
Yeah, it's a good question. I think it's somewhat subjective depending on someone's risk tolerance and aspiration. But in order to properly pursue this type of investment strategy, you do need to have a minimum amount of assets. I'd say that maybe 10 million or more starts making sense, and at 20 million or more, I would say it's almost mandatory at that point in order to properly diversify and maintain and basically improve the probability of that consistent wealth growth.
Yeah. Now, and there's one other piece here. There's there's a piece of how do you construct actually kind of this true exposure, right, of beyond 60-40. And then this is one of the things, we talk about portfolio allocation, right? How do you allocate to these different asset classes? And then there's individual managers within each. And one of the things that, we're talking about this upfront of, within the kind of a really well-run family office, you have kind of the investment piece, which is where you guys go very deep, right? Portfolio construction, the manager choice. There's a tax piece. One of the areas we work very close is there's portfolio construction, and then there's asset location, right? So within these different assets, one of the things is some of these are more tax inefficient and some are more tax efficient. So, and what that practically means is some of these generate tax liabilities every year. Some of these don't generate tax liabilities every year. And then some of those, when they do generate tax liability, they'll generate ordinary income as a tax liability. And so that obviously can draw down returns unless you choose to have those assets owned by tax exempt entities. This is where kind of Valor comes in of we'll set up Charles Manor Trust or other tax exempt structures. And so when you're taking this step back of, when you're talking about the level of wealth that Ty was talking about, you want to, have this truly diversified portfolio where you can, we're looking for that solid 10, 11, 12% every year without the big drawdowns. But then it's also, how do you within that portfolio take those the inefficient asset classes and put them in more tax efficient structures, and then keep the more tax efficient structures, whether it's in your name or more liquid for your use, right? And how do you pull that all together to really maximize liquidity, exposure, and returns? So
that is very true. So we have real life examples of clients that actually use the CRUT structure in order to invest in some of those. So, if you think about a hedge fund structure, we have one hedge fund strategy that's very unique. A little bit like a commercial bank, they give distressed loans to publicly traded companies, and then they can convert to equity if the company does well and then produce really good returns, or they get the hard money rates 12%, or if the company can't pay, they get the stock at a discount. So it's very hard for them to lose money. But all the money that's generated is short-term capital gains, which is effectively ordinary income. So if you have the right planning for these type of vehicles, you can optimize for the tax in a very efficient way. And we do have a lot of clients that own that through that CRET structure for that reason. So you're only paying taxes on the distribution amount.
Yeah, exactly. So you can essentially defer the taxes. Now, there's kind of an interesting piece here is, okay, so let's hopefully, if you don't accept diversification as valuable, please let us know in the comments. We're going to assume everyone does accept diversification as valuable. Now, so there's a question of, okay, I get it. More diversification, more asset classes is probably better than doing just bonds and stocks. But like maybe I don't have to do that now. Now, not to be all like, not to be just very doom oriented, but
Yeah.
you've explained this to me a lot. You think this is probably when we look at the stock market, we are at probably a relative high point or a high risk point. Is that a better way to frame it?
Without getting into doom and gloom and fear mongering, which I love to do. Everybody likes to do that, but we take a value approach to equities as well. So when we think about the holistic portfolio construction, we do feel equities have a place there, right? Because it's a good return driver. It's been consistent for a very long period of time. You definitely want to have equities in the portfolio. How much equities do you want is a key question, right? So there's also a methodology to that. And as much as it's fun to chase the hot sector of today and you want to do all that and you're buying Mag 7, things like that, one of the strongest relationships in finance that goes back 100 plus years. So this is the CAPE ratio, which is a methodology to look at forward back, kind of like smoothing out earnings over the last 12 months. So this is kind of a methodology. You can research what the CAPE ratio means. You're going back to 1900 and you're looking at the valuation of the stock market, where your long-term mean is somewhere around 15 to 20. And just like a regular business, your returns are very much dependent on the valuation that you pay. When you buy a business for cheap, you're going to make a lot of money because you're going to have a lot of cash flows and it's going to be consistent. When you're buying something really expensive, you kind of you need to wait a certain amount of time for it to play out. The stock market's no different over the long run. So over the short run, completely meaningless. This chart is totally meaningless over the short run. However, over a 10-year time horizon, there's a 0.8 correlation, which is very, very strong, one of the strongest relationships in finance, between the average rate of return per year that you're going to get for the next decade and the valuation that you paid. So right now, we're in the most expensive market since the dot-com era, roughly at around 39. And the dot-com era peaked at around 44, 43, something like that. So at 39, we've spent only 2% of the time in all of the last 125 years in this valuation range, where only 1% of the time we went over 40. So again, some people say this time is different because of AI and revolutionary and none of this matters. People said that in 2000 as well, and people said that in the 1920s. Again, maybe it is different this time. No one really knows, not me, not Monty, not everybody. But going back over 125 years, we can say that there's a good chance, 80%, that the returns that are going to happen in the next 10 years are going to be around 0 to -4 real returns, so after inflation. So that means it could mean the market's only going to return 2 to 4% in nominal terms. That's kind of the base case. So that means that, this could be totally wrong. We still want to have an allocation to equities, but because valuations are so high, that allocation is going to be smaller because we have a pretty high probability of a lot of volatility and not a lot of returns. As much as it's AI revolution, NVIDIA going up every day, whatever. But again, NVIDIA is 4% of the global GDP. Does that make sense? I don't know. Maybe it will last longer. But if you need to have some kind of objectives and you need to follow some methodology, to Monty's point, treating it as a science, this is definitely one of the outputs that we use because it is valuation dependent for that purpose.
Yeah. And this was, I remember we were talking, this is one of the things that was more striking to me. So, it is when you realize you're in a area of the market that you've only been in 2% of the time, and you look back at what were those times and, where were those times a year later, it is helpful. Your point is, it's not guaranteed because that's backward looking and who knows, it could be different, but this is when it says the probability of positive returns, it is, lower than it would be in another market.
Right. And the flip side is if you get an historic buying opportunity like 2009, post the global financial crisis, the valuation was below 15. And you can see that your projected historical returns is 8 to 12% for the next 10 years. And that is what happened. So, if you do go through one of these periods, you want to be able to max your ability to buy equities. So you don't necessarily want to, own too much right now. But if you get a valuation discount, you want to be able to have the cash to be able to pull the trigger on a much bigger equity allocation.